So, you've bought a property and your accountant or someone you know has told you that you need to get a tax depreciation schedule. But what is tax depreciation? Hi guys, I'm Tuan, founder of Tax, here for another video designed to help you become a better property investor. You hear about tax deductions, depreciation, low value pooling, and all this jargon, but no one really explains what tax depreciation fundamentally is. And if you're a property investor, what should you do to take advantage of tax depreciation? Put it simply, depreciation is the wear and tear that occurs as things get older. And as items get older, the value of these items also decrease in value. This is depreciation. Where tax gets involved is that you can claim the loss in value as a tax deduction against your income when you lodge your tax return to help you lower how much tax you need to pay or to increase how much of a tax refund you can claim back. But before we start, we want to be clear that this video is for informational purposes. In no way should you use this as tax advice. We always recommend working with a qualified financial advisor or a tax agent to give you the best advice for your situation. When it comes to property investing, which is where Tax specializes in, there are two classes of depreciation you can claim. The first being plant and equipment, known as Division 40 to the ATO, such as your fridges, washing machines, air conditioning units, basically anything that you can remove easily from the property or is motorized. Then you've got capital works, known as Division 43 to the ATO, is the other asset of depreciation, which are things like your building, driveway, roof, and walls. What a lot of investors, mainly first-time investors, don't realize is that you can claim a lot of the tax depreciation based on these two things alone. The ATO provides a tax ruling called an effective life schedule that outlines the effective life of an asset. This is how long the ATO deems a particular asset is generally used to produce income. For example, an air conditioning unit has an effective life of 15 years. From this, we can calculate the rate which we can depreciate the asset either using the diminishing value or prime cost method. If you want to learn more about the depreciation methods, you can check out our other video that talks about this. It's critical to understand that you can only claim depreciation if your investment property is a rental property and it's used purely for investment purposes. If you're living in it as your primary place of residence, you won't be able to claim tax depreciation on the property until you vacate it and start renting it out. So how do you claim tax depreciation? For your property, you'll need a tax depreciation schedule prepared by a qualified quantity surveyor like us here at Tax. You can't get your accountant to do this because it requires a qualified expert in the form of a quantity surveyor to give you an accurate report that's compliant with the ATO. Once you receive this report, if you have an accountant, you would give this to them and they'll make these depreciation claims when they lodge your tax return at the end of each financial year. If you don't have an accountant, you can do it yourself, but we always recommend that you use them to make sure you don't miss out on these deductions that you're eligible for. So, who needs to get a tax depreciation schedule? Here are some scenarios that most often come up with our clients. You've bought a rental property that's either new or off the plan. You've switched your property from a primary place of residence to a rental property. You can claim depreciation from the date you vacate the property and have it available for rent. You run your business from home? You can claim a portion of your home expenses as a tax deduction as well as depreciation on your home. You've bought a residential property and you've entirely or partially demolished the house to renovate it. You can claim scrap value that's residual that's left over in this property, and these are deductions for areas such as the kitchen or your house, as well as for any other newly installed assets. You've purchased a new commercial space that you plan to lease out to somebody or a tenant. You've purchased a commercial space to use for yourself as an owner-occupied business premises. You can potentially claim immediate write-offs allowable by the tax office. If you're in doubt about whether you should get one, speak to a quantity surveyor or your accountant to find out if it's worthwhile. So, when is the best time to purchase a tax depreciation schedule? When you're approaching settlement of your new rental property and have tenants moving into it. It's ideal to organise to have a quantity surveyor to go in before the new tenants move in to avoid disrupting them just before the end of the financial year, so that your accountant can have all the information on hand to lodge your tax return immediately after you receive your notice of assessment or group certificate. You're planning to vacate your home and turn it into a rental property. Again, organise a quantity surveyor before having tenants move into it. I hope this has given you enough information and a good idea of what tax depreciation is. If you're a property investor, old or new, and you haven't taken advantage of tax depreciation, get in touch with our staff at Tax for us to help you.